Hello, friends. Welcome back to my YouTube channel. I'm here to present with you another interesting topic, and it's on diversification. Most of the people think that when they diversify their portfolio, they can make a lot of return. And this is a theme which is being spoken a lot about these days. But here I'm going to tell you what does diversification in real sense mean. What people usually think diversification means they have to buy a lot of things and it will be safe. So they'll buy 12 mutual funds, 27 stocks, 3 gold scream, 1 crypto coin, some random insurance policy, and then they call it like a balanced portfolio. That's not diversification. It's basically a junk drawer. You know that drawer at home that has charger, rubber band, some mysterious keys and all thing in junk nature. So collecting lot of product, it almost becomes like a junk drawer. And this leads to a situation where we are in confusion. He confusion है solution का पता नहीं. So I'm here to give you a solution and we are going to fix the confusion. So the real problem is that you can the common most people the common problem, the common misunderstanding is most people believe more stock means more diversification, more mutual fund with means more diversification, more apps means more financial maturity. The truth is you can own 50 things and still have one risk. You can own 50 things and you still have one risk. And or alternatively, you can own three things and still you can be well diversified. Because diversification is not about quantity, it's about different risk and how are you handling this different risk. So let's understand the simple definition and the real definition of diversification. So real diversification means that your portfolio should not depend on one single story to work. So if your entire portfolio is dependent on maybe one sector doing well, one country doing well, one geography doing well, one theme doing well, or one market mood staying positive, then you are not diversified. You are concentrated and just in the most complicated way. So the real definition of diversification would be that your portfolio should not depend on one single story to work. Now let's understand different boats for different storm mental model. So think of your money like you are planning for for different storms. It could be job loss storm, medical storm, market crash storm, inflation storm. So diversification means that you have a different boat for different storm and not that all 10 boats of the same model. So buying 10 small cap funds is not diversification. It's like a group travel. Maybe this is almost like a fake diversification where you have multiple small cap stocks or multiple small cap mutual fund in your portfolio, but it's not helping you diversify your risk. So let's understand what are the three fake type of diversification that all of us get trapped into. The first is that having many funds. So you would have five large cap funds, four flexi cap funds, three multi cap funds, and all of this are of same style. Though they feel like a diversified, but it's often the overlapping holding risk that you are carrying. So when market falls, everything falls. That's when you realize I diversified. But why am I still crying? Why is my portfolio still bleeding? Because the reality is that many fund can still be one bet only. The another fake diversification that we get trapped into is many stocks in same team. And I have seen this a lot. People buy 12 stocks, maybe all small cap, all mid cap, all high growth stock, all momentum stock. That's not diversification. That's concentration with extra style. If market mood changes, everything corrects at the same time. So when you are having most of the stocks with same theme, It's basically a concentration risk that you are facing, and it's not the diversification that is supporting. The third fake diversification that we get trapped into is different name but the same risk. So the real estate can be known as real estate, RE stock, REITs, but all of them are exposed to same real estate as a base. Maybe tech stock would be like IT stock, Nasdaq ETF, US tech fund. In any name you can be calling it, but its underlying risk is tech. The banking would be bank fixed deposit, bank stock, bank bond. All of these are exposed to same banking risk. So all of this though looks like variety from externally, but the underlying risk driver is same and resulting it in a situation where it is a different wrappers and same risk, which means you can say old wine in a new bottle, similar parameters. So just try to understand whether it's just the nomenclature which is impacting you and it making you feel that the risk is diversified, then that's not the case. Now let's understand what does real diversification actually looks like in a common man version. So first, the real diversification should be across time horizon. So money needed in the 0 to 2 years that you should keep safe. Money that you need in 3 to 5 years that you should put under balance fund. Money that you need after 5 plus years, you put them in a growth fund. That is the first diversification that you do on the basis of time. So if you put your short-term money, the money that you would need on an immediate basis into a long-term asset, then you will panic. That's not the portfolio problem, that's the timeline problem that you are facing. Second is diversification across asset class. So you have to diversify in the sense you should have buckets for equity that would help you capture growth and volatility. Then you should have bucket for debt that will help you to provide stability and lower return. Then you should have bucket for immediate liquidity, which would be cash or emergency fund. Then a bucket for gold that would act as a shock absorber sometime. So you don't need 20 products. You basically need few buckets that behave differently in a different condition. It should is like equity is like a Bollywood. It's like a high drama. Whereas debt is like a Doordarshan, stable but slow. So in similar phases, you have to have your asset class bucket diversified in such a way that each of those buckets are behaving in a different manner. The third diversification strategy would be to keep it very simple. And this is known as a strategy in real sense. The first we talk about timelines, second we spoke about asset class, and then we are talking about strategy. So here it means you have to invest in a broad index fund or a diversified fund, which could be your core portfolio. And then you could have something in the explore portfolio, which would be like a small trade. So the core would be broad index or diversified fund, quality or value or portfolio. And you have when here's something you put it which is high growth that will help you over a period of time, the funds that you know don't need on immediate basis, but you ensure that everything is not high risk, high return. For common people, I would say too many strategies would create a confusion and would not create diversification. So stick to your core strategies, define your core strategy once, stick to it and continue doing that. The real purpose, the real purpose of diversification is to survive and to ensure that you are not struggling with the money that you need on an immediate basis. Because once the survival is in place, the growth can be established. Without survival, growth cannot be established. Diversification is basically not to maximize return, it is to avoid being wiped out during market volatility. Because the biggest enemy is not low return. The biggest enemy is big loss that can make you quit investing forever. So you don't need to win every year, but just need to stay in the game. Now here I'm going to give you 5 question diversification checklist so you don't lose your sleep. The first is, if one sector crashes, do I lose sleep? Is all my investment in that particular sector? If my job is affected, do I have an emergency money separate? If tomorrow equity falls 30%, do I have a stability bucket? Do my mutual fund overlap heavily? Can I explain why I own each thing in one line? So if you can't answer this question, then I would say you don't have adequate diversification. Basically, you have collected lot of investment products that is not helping you meet your financial goal. So to summarize, diversification is not adding more items to your portfolio. It is reducing dependency on one story. Diversification will help you to overcome confusion, and by reducing dependency on maybe a time horizon, on asset class, on the strategy that you're using, or that helping you to avoid concentration, avoid overlap, and have a portfolio that is all weather portfolio. I would say confusion is gone now. You have solution. If you have any further queries, do reach out to me and let me know in the comment section. Is your portfolio diversified, or you are just owning too many things in your portfolio? If you know any of your friend who is struggling to find a portfolio which is adequately diversified, or he or she is facing confusion, please share this video with him or her and let them benefit out of this learning. Let me know in comment section below which are the topics that you are struggling with and you would like me to help you with. I am glad to create a learning out of it. Thank you so much for watching this video.